the banks, the swap dealing banks. They're currently net short about 40,000 contracts. What, 5,000 ounces a contract? That's $200 million. And you're like, well, wait a second. Every dollar that the price goes up, then that's $200 million in losses. So you think, okay, well, they've got an incentive to keep price in check. But the problem, if they keep their price, the New York price in check, and the Shanghai price keeps going like this, well, now that an arbitrage opportunity develops, and all of a sudden the silver that is backing the exchanges, and all their derivatives and the leverage there, all of a sudden they risk losing.
In today's episode, we're focusing on the precious metals market, guided by insights from Craig Hemke, a well-respected analyst in the field of silver and gold, particularly his views on how bullion banks influence these markets. Craig Hemke has pointed out that silver prices are at a significant high, the highest in 11 years, and he believes this upward trend is far from over. The surge is largely driven by a decrease in physical silver supplies and ongoing market dynamics. He particularly highlights the influential role of major bullion banks like Deutsche Bank, HSBC, and JP Morgan, which are active on exchanges such as COMEX and LBMA and deeply impact market movements through their trading strategies. According to Hemke, the silver market is nearing what he describes as a crisis point. With physical supplies of silver dwindling, scenarios similar to a bank run could emerge if the bullion banks continue to maintain large short positions. This situation could lead to increased volatility and potentially rapid changes in silver prices, making the market both risky and ripe with opportunity for alert investors. On the topic of gold, Hemke shares a bullish outlook. Gold prices have hit new all-time highs against the U.S. dollar, reflecting strong demand and favorable economic conditions that typically boost interest in precious metals. Hemke's analysis suggests that global economic pressures and geopolitical uncertainties continue to make gold a highly desirable asset for both private investors and central banks around the world. Now, we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Peak optimism in terms of rate cut expectations, and the dollar index was down to 101, and all of that seemed to be a little too aggressive, given where we were economically. So as the year started, you had to figure, okay, at least the first couple of months are going to be kind of tough for gold and silver. And they were kind of tough. I mean, gold and silver both going down for maybe till about Valentine's Day. And then gold started to perk up. It actually then formally broke out of about a 3.5-year price range back on Friday, the 1st of March. Rallied $100 the next week on, just people being enthusiastic and seeing that breakout. And then, we're up another couple $100 from there. Again, in the face of dwindling rate cut expectations and a rising dollar. So that was all, caught even me. I was caught kind of flat footed by that too. I was expecting, maybe this happened by summertime, as it's pretty clear the economy is slowing, but instead it takes off. Silver waited about a month, was watching what gold was doing, and then said, okay, I want to play along too. And so on April the 1st, silver took off. And now here we are 8 weeks later, and it's gone from about 24.50 up to 32. So what's that, 30 some odd percent? It too has now broken out of that about 4-year trading range, and that's gotten a lot of people's attention. That the tough thing I shouldn't say tough thing. The challenge to remember is that even though the pricing ability is demonstrably shifting east, it hasn't fully shifted there yet. And as long as the derivative and the paper markets are still playing a role in London and in New York, you're always going to move up in stages. So yes, it's great. Silver's broken out. Yes, it's fantastic. It's $32 an ounce, but that does not mean it's going to be $62 an ounce by the 4th of July. Okay. That's not how it works, man. And you mentioned part of that. Then again, you get you get rally, get people to come in. And then price kind of rolls over, and then it kind of flushes back out and then pulls back, and then it's ready to move up again. And that's just kind of the ebb and the flow of how price is discovered when you trade derivatives to do that. And so we should still continue going higher from here, but it's this, not straight up like some people would hope.
In today's market recap, silver price gains are outshining gold's thanks to China's overproduction of solar panels. Silver prices have soared 35% this year, hitting 12-year highs at about $32 an ounce. Silver's rise is driven by industrial demand, especially for solar panels, amid green energy shifts. China's strong silver demand boosts imports, with domestic prices higher than international rates. Record high gold prices are in the spotlight, but it's really the yellow metal's poorer cousin, silver, that's outperforming in the price rally. Spot silver prices have gained 35% this year to date, reaching 12-year highs. They're now about $32 an ounce. In comparison, but have gained just 14% so far this year. While gold's bull run has been driven by central banks' desire to diversify their assets and a consumer flight to safety amid macroeconomic uncertainties, particularly in China, silver's dazzling performance this year is underpinned by industrial demand. In particular, silver is a key raw material for solar panels. They're in demand amid the world's transition to sustainable energy, and China has raced to manufacture them. China's demand for silver is so strong that domestic prices of the precious metal are higher than international prices. Now, we'll show you the best clips of the latest interview, but first, like and subscribe, as people who regularly watch our videos are better informed.
Absolutely. And you can, there's these ideas that are, some people say, are opposed to each other. Somehow they're mutually exclusive, but they're not. The bullion banks can manage and manipulate the price of the precious metals to certain price targets almost on a daily basis. But that doesn't mean price can't go up. I mean, that evidence is right staring you in the face, right? Gold's gone from $400 to $2,400 in the last 20 years. But the bullion banks, there's still a JP Morgan Global Precious Metals desk, right? There's still Citigroup. There's still, UBS, Goldman Sachs, go down the list. So there's money to be made. What they can't have is a 50% year. That'd be catastrophic. I think the best year we've seen, while we've gone from 400 to 2,400 is about 25%, 28% back in 2011. Okay. They can manage 10%, 30%, 50% is a whole other deal. And that gets back to what you mentioned earlier, Dunnigan, about the four heads of different bullion banks, these trading desks, JP Morgan and HSBC, and I can't remember what the other two were, all ran over to Shanghai back from a period of late March into early April. I mean, there's Reuters stories on all four of them. Some of them use the same picture. And that they're just caught in a jam now in silver, in that, we get reported through the CFTC their gross positions, and, and you can compute the net positions every week with the commitment of traders reports. We know from that data as a group how much net short they are, not even including the producers that are allegedly hedging or selling forward, just what are called the banks, the swap dealing banks. They're currently net short about 40,000 contracts. What, 5,000 ounces a contract? That's $200 million. And you're like, well, wait a second. Every dollar that the price goes up, then that's $200 million in losses. So you think, okay, well, they've got an incentive to keep price in check. But the problem, if they keep their price, the New York price in check, and the Shanghai price keeps going like this, well, now that an arbitrage opportunity develops, and all of a sudden the silver that is backing the exchanges, and all their derivatives and the leverage there, all of a sudden they risk losing some of that. So it's like, okay, we can either keep the price low to keep our paper short position from, accumulating a couple $1 billion in losses, or we could risk kind of an existential event and have our vaults get drained. And so that's what I mean, kind of a rock and a hard place. Now, one last thing though on that. To you and me, it sounds simple, right? It's like, hey, look, Shanghai last night was trading $36 an ounce. And in the US, it's 32. So a simple arbitrage is you buy in the US and you sell in Shanghai. US price goes up from the buying, the Shanghai price goes down from the selling, and and you close that gap. Well, is $4 enough to make that profitable? Is $4 enough to take the risk? And that's something that when I hear people or read people talking about this potential arbitrage, I think gets left out, because to execute that trade and to close that gap, you have to buy in the West and sell in Shanghai. Okay, well, if you're buying in the West for future delivery in Shanghai, you better be darn sure you can actually get your hands on that metal, much less ship it over there and do everything else, and customs and everything else you got to do to get the metal into China itself. Because otherwise, the other end of this thing is short. So do you want to be, if the COMEX or a bank in New York says, we'll get you this in 90 days, do you want to be left hanging out here short in Shanghai? Right? It's like getting sideways with some of the guys, walking down the street in Newark. I'm thinking about, like a Sopranos episode or something here. I don't want to get sideways with Shanghai at all on this deal. So there's a risk to putting on that ARB, just because I don't think anybody could ever feel comfortable in size, a couple thousand contracts worth, 10 million ounces or something in size, enough to make that ARB worthwhile. And so it just continues to widen and keep going this way. Again, it's a very interesting situation we're in, and not one that many of us really anticipated as the year began.
What do you think of today's show? Will the Shanghai COMEX arbitrage destroy all shorts, as Hemke pointed out? Will gold and silver soar, destroying the banking industry? Post in the comments section down below your honest opinion, and watch this video right here because it's a perfect fit for you. I see you on the other side.